Section 3.1 to 3.3 Cost averaging. 3.1 Market timing versus time in the market. Understanding the limitations of market timing and the potential risks involved is crucial for successful investing. Here are some key points to consider. Difficulty in predicting market movements. Market timing involves attempting to predict future market movements to buy or sell investments at the most opportune times. However, accurately predicting short-term market movements consistently is extremely challenging, if not impossible. Even experienced investors and professionals often struggle with market timing. Emotional and behavioral biases. Market timing can be influenced by emotions and behavioral biases, such as fear, greed, and overconfidence. Emotional decision-making can lead to impulsive actions based on short-term market fluctuations, which may result in poor investment outcomes, missed opportunities. Trying to time the market effectively requires getting both the buy and sell decisions right. It means not only knowing when to sell before a market decline but also when to buy before a market upswing. If you miss out on even a few of the best-performing days in the market, it can significantly impact your overall investment returns, transaction costs, and taxes. Frequent buying and selling of investments can lead to higher transaction costs, such as trading fees and commissions, which can eat into your returns. Additionally, short-term capital gains tax rates are typically higher than long-term capital gains rates, potentially reducing your after-tax returns if you engage in frequent trading. Time in the market versus timing the market. Instead of trying to time the market, a more effective approach is to focus on time in the market. By staying invested over the long term and consistently contributing to your investments, you can benefit from the power of compounding and reduce the impact of short-term market volatility. Long-term investment horizon. Successful investing is often best suited for a long-term investment horizon. Market timing is more speculative and suited for short-term trading strategies. Long-term investors are generally better served by developing a well-diversified portfolio and staying committed to their investment plan. Consistency and discipline. Consistency and discipline are vital for long-term investment success. Trying to time the market requires making frequent decisions, which can be mentally and emotionally exhausting. A disciplined approach, such as dollar-cost averaging, focuses on regular contributions and staying invested through various market cycles. Professional expertise. Even professional investors, with access to vast resources and research, find it challenging to consistently time the market. Retail investors without the same level of resources and expertise may face even greater difficulties. It's important to note that market timing strategies can occasionally yield positive results, especially for skilled and experienced traders. However, the risks and challenges associated with market timing outweigh the potential benefits for most individual investors. A more prudent approach for long-term investors is to focus on fundamental investment principles such as asset allocation, diversification, regular contributions, and a disciplined investment strategy. By staying invested and taking a long-term perspective, you can mitigate the risks of market timing and increase the likelihood of achieving your investment goals. Emphasizing the importance of long-term investing and time in the market is crucial for achieving investment success. Here are some key points to consider. Power of compounding. Time in the market allows you to take advantage of the power of compounding. Compounding refers to earning returns on both your original investment and the accumulated gains over time. The longer your investment remains in the market, the more time it has to grow and potentially generate significant returns. Smoothing out market volatility. Short-term market fluctuations are a normal part of investing. However, the impact of market volatility tends to diminish over longer time horizons. By staying invested for the long term, you give your investments a better chance to recover from short-term market downturns and benefit from long-term market growth. Riding the ups and downs. Trying to time the market to avoid downturns and capture upswings is extremely challenging. It requires making accurate predictions consistently, which is difficult even for seasoned professionals. By staying invested in the market over the long term, you can ride out market fluctuations and potentially benefit from the overall upward trajectory of the market. Overcoming short-term noise. Short-term market news, economic indicators, and geopolitical events can create noise that may tempt investors to make impulsive and emotional decisions. Long-term investing helps to filter out the short-term noise and focus on the fundamental performance and growth of your investments. Avoiding market timing pitfalls. market timing attempts to buy and sell investments based on short-term market movements. However, research has shown that timing the market consistently and accurately is extremely challenging. Trying to time the market can lead to missed opportunities, increased transaction costs, and higher tax implications. Aligning with economic growth, investing in the market over the long term aligns with the overall economic growth of businesses and economies. As companies grow and expand, their value and earnings potential generally increase over time. By participating in the long-term growth of the market, you can benefit from the success of these companies. Discipline and patience. Long-term investing requires discipline and patience. It means sticking to your investment plan and resisting the temptation to make impulsive decisions based on short-term market movements. By maintaining a long-term perspective and staying committed to your investment strategy, you are more likely to achieve your financial goals. While short-term trading strategies can be enticing, they often involve higher risks, increased transaction costs, and a greater emphasis on accurate market timing. Long-term investing, on the other hand, allows you to benefit from the historical trend of the market's growth and the compounding effect over time. It's important to note that long-term investing does not guarantee a profit or shield you from short-term market fluctuations. However, it provides a more reliable and statistically supported approach to building wealth and achieving your financial objectives. By focusing on the long term and giving your investments time to grow, you increase the potential for favorable returns and reduce the impact of short-term market volatility. Mitigating the impact of short-term market fluctuations on investment returns requires a thoughtful approach and adherence to key investment principles. Here are some strategies to consider. Diversification. Diversification is a risk management strategy that involves spreading your investments across different asset classes, such as stocks, bonds, real estate, etc., and within each asset class, such as different industries or regions. By diversifying your portfolio, you reduce the impact of a single investment or sector on your overall returns. When one investment is performing poorly, others may be performing well, helping to balance out your portfolio's performance. Asset allocation. Asset allocation refers to the strategic distribution of your investments among different asset classes based on your risk tolerance, financial goals, and time horizon. By establishing an appropriate asset allocation that aligns with your investment objectives, you can reduce the impact of short-term market fluctuations. A well-diversified portfolio with a suitable asset allocation can provide stability and potential for long-term growth. Long-term perspective. Maintain a long-term perspective and avoid making impulsive investment decisions based on short-term market fluctuations. Remember that markets are cyclical and will experience ups and downs over time. By focusing on your long-term investment goals and staying committed to your investment plan, you can better weather short-term market volatility. Dollar cost averaging. Dollar cost averaging, DCA, is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. With DCA, you automatically buy more shares when prices are low and fewer shares when prices are high. This approach helps to smooth out the impact of short-term market fluctuations and takes advantage of market downturns by acquiring more shares at lower prices over time. Regular portfolio reviews. Regularly review your investment portfolio to assess its performance and ensure it remains aligned with your financial goals and risk tolerance. Conduct periodic reviews to rebalance your portfolio if necessary, bringing it back to your desired asset allocation. Rebalancing involves selling assets that have appreciated significantly and reinvesting in assets that have underperformed, maintaining your desired risk profile. Avoid emotional decision-making. Emotions can drive impulsive investment decisions during periods of market volatility. Avoid making decisions based on fear or greed. Stick to your long-term investment strategy and avoid trying to time the market or chase short-term trends. Emotional decision-making can often lead to poor investment outcomes. Stay informed and seek professional advice. Stay informed about market trends and economic developments, but avoid getting overwhelmed by short-term news and noise. Keep yourself educated and up to date on your investments, but be cautious of overreacting to short-term market fluctuations. Consider seeking professional advice from a financial advisor who can provide guidance based on your specific financial situation and investment goals. Remember, it's important to assess your risk tolerance, financial goals, and time horizon when implementing these strategies. What works best for one investor may not be suitable for another. By implementing these strategies and staying focused on your long-term investment objectives, you can mitigate the impact of short-term market fluctuations and increase the likelihood of achieving your financial goals. 3.2 Assessing risk tolerance. Evaluating risk tolerance is a critical step in making informed investment decisions. Risk tolerance refers to your ability and willingness to endure fluctuations or potential losses in the value of your investments. It is influenced by several factors and plays a significant role in determining your investment strategy. Here's how risk tolerance influences investment decisions. Financial capacity. Your financial capacity to withstand potential losses is a crucial aspect of risk tolerance. It involves evaluating your current financial situation, including income, expenses, savings, and overall net worth. Investors with higher financial capacity may be more willing to take on greater investment risks, while those with lower financial capacity may prefer more conservative investment approaches. Investment goals and time horizon. Your investment goals and time horizon also influence your risk tolerance. Short-term goals, such as saving for a down payment on a house in the next year, typically call for lower-risk investments to preserve capital. In contrast, long-term goals, such as retirement planning over several decades, may allow for a higher risk tolerance as there is more time to ride out market fluctuations and potentially benefit from higher returns. Emotional and psychological factors. Risk tolerance is also influenced by emotional and psychological factors. Some individuals may have a higher tolerance for market volatility and are comfortable with the potential ups and downs of their investments. Others may experience more anxiety or stress during market downturns and prefer lower-risk investments to maintain a sense of security and peace of mind. Investment knowledge and experience. Your level of investment knowledge and experience can impact your risk tolerance. Those who are more knowledgeable about investing and have experience with market fluctuations may be more comfortable taking on higher risks. Conversely, investors with limited knowledge or experience may have a lower risk tolerance and prefer more conservative investment options. Personal preferences and values. Risk tolerance is also influenced by personal preferences and values. Some individuals may be naturally inclined to take on more risks and seek higher potential returns. Others may prioritize capital preservation and prioritize investments with lower volatility, even if it means potentially sacrificing higher returns. It's essential to evaluate your risk tolerance carefully before making investment decisions. Here are a few considerations. Risk assessment tools. Utilize risk assessment tools provided by financial institutions or consult with a financial advisor to evaluate your risk tolerance objectively. These tools typically involve a questionnaire that considers various factors to determine your risk profile. Diversification. Diversification can help manage risk by spreading investments across different asset classes, sectors, and regions. It helps reduce the impact of any single investment on your overall portfolio and can align with different risk tolerance levels. Investment allocation. Align your investment allocation with your risk tolerance. Conservative investors may favor a higher allocation to fixed income securities, such as bonds, while aggressive investors may lean towards equities with higher growth potential. Finding the right balance between risk and potential returns is key. Regular portfolio reviews. Regularly review and reassess your investment portfolio to ensure it remains in line with your risk tolerance. If your risk tolerance changes over time due to personal circumstances or market conditions, it may be necessary to adjust your investments accordingly. Professional advice. Consider seeking guidance from a financial advisor who can help assess your risk tolerance, understand your investment goals, and recommend an appropriate investment strategy. A professional can provide valuable insights and help you navigate the complexities of investing. Remember, risk tolerance is a personal decision and can vary among individuals. It's important to strike a balance between your risk tolerance, investment goals, and financial capacity. By aligning your investment decisions with your risk tolerance, you can build a portfolio that meets your needs and provides the potential for long-term success. Balancing the desire for potential returns with the ability to tolerate market volatility is a crucial consideration in investment decision-making. Here are some key points to help you find the right balance. Assess your risk tolerance. Evaluate your risk tolerance objectively by considering factors such as financial capacity, investment goals, time horizon, emotional factors, and personal preferences. This assessment will help you understand how much volatility you can withstand and guide your investment decisions. Define your investment objectives. Clearly define your investment objectives, including the desired returns you hope to achieve and the timeline for achieving them. Your investment goals will help determine the level of risk you're willing to take on and the potential returns you may expect. Understand the risk-return trade-off. In investing, there is a fundamental trade-off between risk and return. Generally, investments with higher potential returns tend to come with higher levels of volatility or risk. It's important to recognize that seeking higher returns often involves accepting a greater degree of market fluctuations. Diversify your portfolio. Diversification is a strategy that can help balance potential returns and manage risk. By spreading your investments across different asset classes, sectors, and geographic regions, you can reduce the impact of volatility on your overall portfolio. Diversification can help mitigate losses in one area by capturing gains in others. Consider your time horizon. The length of your investment horizon can influence your tolerance for market volatility. If you have a longer time horizon, you may be more willing and able to withstand short-term fluctuations in pursuit of potentially higher returns. For shorter-term goals, preserving capital and minimizing volatility may be a higher priority. Stay informed and educated. Continuously educate yourself about the investments you hold and the market conditions. Understanding the underlying fundamentals of your investments can help you make informed decisions and avoid making impulsive choices based solely on short-term market movements. Regularly review and rebalance. Regularly review your investment portfolio to ensure it remains aligned with your risk tolerance and investment objectives. Rebalance your portfolio if necessary by buying or selling assets to restore your desired asset allocation. This helps maintain the intended risk-return profile of your portfolio. Seek professional guidance. Consider seeking guidance from a financial advisor who can provide expertise and help you navigate the balance between potential returns and market volatility. A professional can assist in assessing your risk tolerance, understanding different investment options, and creating a suitable investment strategy. Ultimately, finding the right balance between potential returns and tolerance for market volatility is a personal decision. It involves assessing your individual circumstances, risk tolerance, investment goals, and time horizon. Regularly reassess your risk tolerance and adjust your investment strategy as needed to stay on track toward your financial objectives. Aligning your investment strategy with your individual risk tolerance level is crucial for a successful and comfortable investing experience. Here's how you can achieve this alignment. Understand your risk tolerance. Begin by understanding your risk tolerance level through a careful evaluation of your financial situation, investment goals, time horizon, emotional factors, and personal preferences. Assessing your risk tolerance objectively will provide a foundation for designing an appropriate investment strategy. Define investment goals. Clearly define your investment goals, both short-term and long-term. Different goals may have varying risk tolerance requirements. For example, if you have a longer time horizon for a particular investment goal, you may be able to tolerate higher levels of volatility. Determine risk capacity. Evaluate your financial capacity to handle risk. Consider factors such as your income, expenses, savings, and overall net worth. Understanding your financial capacity will help you determine the level of risk you can comfortably take on without jeopardizing your financial stability. Establish asset allocation. Asset allocation is the strategic distribution of your investments across different asset classes, such as stocks, bonds, real estate, and cash. It plays a crucial role in aligning your investment strategy with your risk tolerance. A more conservative investor may have a higher allocation to bonds or cash, while a more aggressive investor may have a higher allocation to stocks. Diversify your portfolio. Diversification is key to managing risk and aligning with your risk tolerance. Spread your investments across different asset classes, sectors, and geographic regions. Diversification helps reduce the impact of any single investment on your portfolio and potentially mitigates losses during market downturns. Consider risk-adjusted returns. Assess investments not only based on their potential returns but also on their risk-adjusted returns. Some investments may offer higher returns but come with higher levels of risk. Evaluate the risk-reward trade-off and select investments that provide an appropriate balance for your risk tolerance. Monitor and rebalance. Regularly monitor your portfolio to ensure it remains in line with your risk tolerance. Over time, market movements can cause your asset allocation to deviate from your intended risk profile. Rebalance your portfolio by buying or selling assets to realign with your desired allocation. Seek professional advice. If you're unsure about aligning your investment strategy with your risk tolerance, consider seeking guidance from a financial advisor. A professional can help assess your risk tolerance. Understand your goals, and create an investment plan tailored to your individual circumstances. Remember that risk tolerance is personal and can change over time. Reassess your risk tolerance periodically, particularly when your financial situation or investment goals evolve. Aligning your investment strategy with your risk tolerance ensures that you are comfortable with the level of risk you are taking and increases the likelihood of staying committed to your investment plan over the long term. 3.3 Monitoring and rebalancing. Regularly monitoring the performance of your investment portfolio is an important practice to ensure that your investments remain aligned with your goals and risk tolerance. Here are some key points to consider when monitoring your portfolio. Establish monitoring frequency. Determine how often you will review and monitor your portfolio. The frequency may vary depending on your investment strategy, time availability, and the nature of your investments. Common intervals include quarterly, semi-annually, or annually. It's important not to over-monitor your portfolio, as short-term fluctuations can lead to unnecessary stress or impulsive decision-making. Review investment objectives. Regularly assess whether your investment objectives remain consistent with your financial goals. If your objectives or circumstances have changed, it may be necessary to adjust your portfolio accordingly. Revisit your short-term and long-term goals to ensure that your investments are aligned with your evolving needs. Evaluate performance. Evaluate the performance of your investments relative to your expectations and benchmarks. Compare your portfolio returns to relevant market indices or other appropriate benchmarks. This analysis will provide insight into how your investments are performing and whether adjustments may be necessary. Assess asset allocation. Review your asset allocation to ensure it remains in line with your desired risk profile. Changes in market conditions or specific investments can cause your portfolio to deviate from your intended allocation. Consider rebalancing your portfolio if necessary by buying or selling assets to realign with your target allocation. Monitor individual investments. Assess the performance of individual investments within your portfolio. Identify any holdings that consistently underperform or exhibit concerning trends. Regularly evaluate the fundamentals, news, and outlook for each investment to determine whether they continue to meet your expectations. Consider risk management. Monitor the risk level of your portfolio and assess whether it aligns with your risk tolerance. Ensure that you have adequately diversified your investments to mitigate risk. Identify any potential concentration risks or vulnerabilities within your portfolio and take appropriate action to address them. Stay informed. Stay informed about market trends, economic developments, and any relevant news that may impact your investments. Regularly update your knowledge and stay in touch with your financial advisor or investment professionals to gain insights and perspectives. Review fees and costs. Assess the fees and costs associated with your investments. Understand the impact these costs have on your overall returns and evaluate whether they are reasonable and aligned with the value provided. Document and track. Maintain records of your portfolio performance, including transaction history, returns, and any adjustments made. This documentation will help you track the progress of your investments over time and provide a reference for future decision-making. Seek professional advice. If you are unsure about monitoring your portfolio or need assistance in evaluating its performance, consider consulting with a financial advisor or investment professional. They can provide guidance, expertise, and an objective perspective on your investments. Regularly monitoring your investment portfolio allows you to stay informed, make informed decisions, and make adjustments as needed. It helps ensure that your investments continue to align with your financial goals and risk tolerance. Remember to maintain a long-term perspective and avoid making impulsive decisions based solely on short-term fluctuations in performance. Assessing the need for rebalancing your investment portfolio is an important step in maintaining your desired asset allocations. Rebalancing involves realigning your portfolio back to its target asset allocation when it deviates due to market movements or changes in the value of your investments. Here are some factors to consider when assessing the need for rebalancing. Determine a target asset allocation. start by establishing a target asset allocation that reflects your risk tolerance, investment goals, and time horizon. Your asset allocation specifies the percentage of your portfolio allocated to different asset classes such as stocks, bonds, cash, and other investments. Set rebalancing thresholds. Determine the thresholds that will trigger a rebalancing. For example, you may decide to rebalance when an asset class deviates by a certain percentage from its target allocation. Common thresholds are around 5% to 10%, but it ultimately depends on your preferences and the level of precision you desire. Regularly monitor your portfolio. Regularly monitor the performance of your investments and track the current asset allocation of your portfolio. Keep an eye on any significant deviations from your target allocation. This monitoring can be done quarterly, semi-annually, or annually, depending on your preferences. Consider market conditions. Evaluate the impact of market conditions on your asset allocation. Certain market events or economic factors may cause certain asset classes to outperform or underperform, leading to imbalances in your portfolio. Assess whether these deviations are short-term fluctuations or if they represent a longer-term trend. Review risk tolerance and investment goals. Reassess your risk tolerance and investment goals periodically. As your circumstances change, your risk tolerance and investment objectives may evolve. A change in risk tolerance or goals may warrant a shift in your asset allocation, prompting the need for rebalancing. Evaluate transaction costs and tax implications. Consider the transaction costs and potential tax implications associated with rebalancing. Rebalancing may involve buying and selling assets, which could incur fees or generate taxable events. Evaluate the impact of these costs and tax consequences to determine if rebalancing is worth the potential benefits. Maintain a long-term perspective. Keep in mind that rebalancing is a long-term strategy aimed at maintaining your desired risk-return profile. Avoid making knee-jerk reactions based on short-term market movements. Stay focused on your investment goals and the benefits of a disciplined, systematic approach to rebalancing. Seek professional advice. If you are unsure about the need for rebalancing or how to execute it effectively, consider consulting with a financial advisor. A professional can provide guidance based on your specific circumstances, risk tolerance, and investment goals. Remember that rebalancing is a personal decision, and there is no one-size-fits-all approach. The need for rebalancing will depend on your individual circumstances and preferences. Regularly assessing your portfolio's asset allocation and considering the factors mentioned above will help you determine if rebalancing is necessary to maintain your desired asset allocations and keep your investment strategy on track. Adjusting the dollar-cost averaging (DCA) strategy based on changing market conditions is an important aspect of active portfolio management. While DCA is typically a systematic and disciplined approach that involves investing a fixed amount at regular intervals, there are certain considerations to keep in mind when adjusting the strategy. Assess market conditions. Stay informed about market trends, economic indicators, and other factors that may impact your investments. Monitor market volatility, interest rates, geopolitical events, and industry-specific developments. Understanding the current market conditions will help you make informed decisions about adjusting your DCA strategy. Revisit investment thesis. Regularly reassess your investment thesis and evaluate whether it remains valid in light of changing market conditions. Consider factors such as the outlook for the asset class or individual investments, fundamental analysis, and any new information that may affect your investment decisions. Adjust investment amounts. Depending on your assessment of market conditions, you may consider adjusting the amount you invest through DCA. If you anticipate favorable conditions, you might increase your investment amounts to take advantage of potential opportunities. Conversely, if you have concerns about the market, you may choose to decrease your investment amounts temporarily or hold off on additional investments. Modify frequency of investments. Another way to adjust your DCA strategy is by modifying the frequency of your investments. If market conditions are volatile or uncertain, you might consider increasing the frequency of your investments to take advantage of potential price fluctuations. Conversely, in stable market conditions, you may opt to decrease the frequency of investments. Stay disciplined. While adjustments can be made to your DCA strategy based on changing market conditions, it is important to maintain discipline and avoid making impulsive decisions. Stick to your long-term investment goals and avoid trying to time the market. DCA is designed to smooth out market volatility and minimize the impact of short-term fluctuations. Seek professional advice. If you are uncertain about adjusting your DCA strategy or need guidance on how to adapt to changing market conditions, consider consulting with a financial advisor or investment professional. They can provide insights, expertise, and an objective perspective to help you make informed decisions. Remember, market conditions can be unpredictable, and timing the market consistently is challenging. DCA is a strategy that helps reduce the impact of market volatility by spreading your investments over time. While adjustments can be made based on changing market conditions, the core principle of DCA is to maintain a disciplined and systematic approach to investing, focusing on long-term goals rather than short-term market fluctuations.